I need you to stop and pay very close attention because what just happened in the last 48 hours broke every single rule about how silver is supposed to behave during geopolitical crises. Iran just attacked the United States Embassy in Saudi Arabia with drones. 6 American soldiers are dead. Israel is bombing Tehran. The Strait of Hormuz is closed. Oil prices are spiking. This is an actual shooting war in the Persian Gulf. And silver crashed from $96 to $80, down $16 in 24 hours. A 16% collapse while bombs are literally falling on American diplomatic facilities in the Middle East. Read that again because this is not supposed to happen. Silver is supposed to be the safe haven trade, the geopolitical fear asset, the metal you buy when wars break out and uncertainty explodes. But while Iranian drones were hitting the U.S. Embassy in Riyadh, while Trump was promising to escalate strikes across Iran, while the death toll climbed past 787 people, silver didn't rally. It collapsed. And when I show you why, when you see what the U.S. dollar index just did, when you understand the mechanism that's currently destroying the safe haven thesis, you're going to realize we're watching something that hasn't happened in 50 years. A war that makes the dollar stronger instead of weaker, a geopolitical crisis that kills precious metals instead of lifting them, and a massive profit-taking massacre that just wiped out every late buyer who thought Iran conflict meant automatic silver gains. Let me show you exactly what happened and why the next 72 hours could determine whether silver goes to 100 or back to 60. Here are the facts. Silver peaked at $96 on March 1st. That was 48 hours into the Iran conflict. U.S. and Israeli forces had just killed Iran's supreme leader, Ayatollah Ali Khamenei. Operation Epic Fury was escalating. Fear was at maximum levels. And then March, second hit. The U.S. dollar index surged from 97 to 99.39 in less than 36 hours. The sharpest dollar rally since early 2025. A 2.4% move in the greenback in a single session. And the moment the dollar spiked, silver started falling. 96 became 92. 92 became 88. 88 became 84. By March 3rd, silver had touched $80. $16 gone in 2 trading days. Now here's what you need to understand about that dollar move, because this is the key to everything. The dollar didn't rally despite the Iran war. It rallied because of the Iran war. Think about that for a second. War breaks out in the Persian Gulf. The Strait of Hormuz closes. 20% of global oil supply gets threatened. American embassies get attacked by Iranian drones. And instead of fleeing to gold and silver, global capital fled to the US dollar. Why? Because when shit gets real, when actual shooting starts, when supply chains break and shipping stops, there's only one currency on earth that matters. The US dollar. Not euros, not won, not yen. The dollar. And here's the mechanic that's killing silver right now. When the dollar strengthens this violently, this fast, it creates a deflationary impulse across every commodity market on the planet. Oil, copper, wheat, and yes, silver. Because commodities are priced in dollars globally. When the dollar appreciates 2% in 36 hours, it makes every dollar-denominated commodity 2% more expensive for foreign buyers holding euros or yen or yuan. Chinese manufacturers who need to buy silver suddenly find it costs 2% more in yuan terms, even if the dollar price hasn't moved. European industrial buyers face the same problem. Japanese electronics makers paying in yen see their silver costs spike. So they stop buying, they wait, they delay orders. And that demand destruction shows up immediately in the futures market as selling pressure. But it gets worse. Because the dollar surge isn't happening in isolation. It's happening because the Federal Reserve just changed its entire rate cut trajectory based on inflation fears. The Strait of Hormuz is closed. Oil just spiked from $82 per barrel to $97 in 3 days. $15 move. That's a 20% jump in crude prices in 72 hours. And what does higher oil mean? It means higher inflation, higher gasoline prices, higher transportation costs, higher input costs for every manufacturer in America. The Fed was supposed to cut rates in July. Markets had priced in 2 25 basis point cuts for 2026. That narrative just died. Because if oil stays at 97 or goes to 100, if energy-driven inflation reignites, the Fed cannot cut rates. They have to keep policy tight. They have to maintain restrictive rates to fight inflation. And that makes U.S. Treasury yields more attractive, which pulls capital into dollars and out of zero-yield assets like silver. So now you have a double whammy hitting silver, dollar strength making commodities expensive for foreign buyers, and Fed policy expectations shifting from dovish cuts to hawkish holds. That's a toxic combination for any asset that doesn't pay interest or dividends. And silver pays nothing. It just sits there. So when real yields on U.S. Treasuries become more attractive, capital rotates out of silver and into bonds. Now let me show you the profit-taking side of this equation, because this is where the massacre really happened. Silver went from $30 in early 2025 to $121 on January 30th, 2026. That's a 290% gain in 13 months. Every retail investor who bought at 30 or 50 or 70 was sitting on massive unrealized profits by late February. 300% gains, 200% gains, 150% gains. And when Iran war headlines hit, when silver spiked to 96, what do you think those retail holders did? They sold. They took profits. They locked in gains before the rally could reverse, because they remembered what happened on January 30th. Silver hit 121 and crashed to 74 in 9 days, a $47 collapse, 38% drawdown, the worst single-day drop since 1980. That crash burned everyone who didn't sell the top. Everyone who held through the peak hoping for 150 or 200 got destroyed when margin calls hit and leverage unwound. So when silver rallied to 96 on Iran fears, when it approached those January highs, the PTSD kicked in. Sell now before it crashes again. Lock in profits before another margin liquidation event wipes out the gains. And that selling pressure met dollar strength and Fed hawkishness at exactly the wrong time. The combination created a cascading liquidation that took silver from 96 to 80 in 48 hours. Now let me show you the managed money positioning data, because this explains why the sell-off was so violent. Managed money long positions in COMEX silver had climbed from 12,000 contracts to 28,000 contracts between late February and early March. That's 16,000 new contracts of speculative buying, 80 million ounces of paper demand that piled into silver as Iran tensions escalated. Hedge funds, CTAs, momentum traders, all buying the geopolitical fear narrative. But here's the problem with speculative positioning. It's not industrial demand. It's not physical accumulation. It's leveraged paper trading that reverses the moment the trend breaks. And when the dollar spiked to 99, when silver broke below $90, those specs started liquidating. Stop losses triggered. Algorithms detected the breakdown. Momentum reversed. 16,000 contracts of buying became 16,000 contracts of selling in less than 2 sessions. 80 million ounces of paper demand flipped to 80 million ounces of paper supply. And the futures market couldn't absorb that flow without gapping lower. So silver went from 96 to 92 to 88 to 84 to 80 in a straight line. No bounces, no support, just algorithmic liquidation accelerating on every breakdown. And here's what makes this even more painful for late buyers. Physical silver premiums collapsed at the same time. Silver Eagles were trading at $12 to $15 premiums over spot in late February. Dealers charging $108 for coins when spot was $96. But as spot crashed to 80, premiums compressed to $6 to $8. Some dealers dropped to $4 premiums. Why? Because retail investors who had been buying physical at 90 or 95 started panicking and selling back to dealers. The bid-ask spreads widened. Dealers lowered buy prices to protect themselves from falling spot. And suddenly the physical market that was supposed to hold firm during crashes started behaving exactly like the paper market. No floor, no premium support, just selling pressure from retail holders who bought the Iran war narrative at the top and now wanted out before losses got worse. Now I want to show you what's happening with industrial buyers, because this is where the disconnect becomes really interesting. Solar panel manufacturers, EV makers, electronics producers, the industrial users who actually need silver for production. They're not buying right now. They're waiting. Because if silver can drop from 96 to 80 in 2 days during an actual war, what happens if peace breaks out? What happens if Trump and Iran negotiate? What happens if the Strait of Hormuz reopens? Industrial buyers are thinking silver could go to 70 or 65 or 60, so why lock in supply at 80 when you might get it at 65 in 2 weeks? That's the problem with volatility this extreme. It destroys price discovery. Nobody knows what fair value is anymore. Is silver worth 80, 90, 70, 100? The range is so wide that buyers just step aside and wait. And when industrial buyers step aside, when the physical demand that's supposed to create floors disappears, silver becomes a pure momentum trade. And momentum just reversed violently to the downside. Let me show you the technical damage that just occurred. Silver broke below its 20-day moving average at $91. Then it broke the 50-day at 87. Then it crashed through the key 85 support level that had held since mid-February. Every support level failed. Every bounce got sold. And now silver is trading at 80 with the next major support not until $75. That's the January post-crash recovery low. If 80 doesn't hold, there's $5 more of air underneath. And here's what the chart is telling traders right now. The Iran war rally failed. Silver couldn't hold 96, couldn't break through to challenge the January highs at 121. The momentum is broken. The uptrend is over. Sell rallies, short bounces. That's the message from price action. And when price action sends that signal, when technicals break down, fundamental narratives don't matter anymore. It doesn't matter that there's a war. It doesn't matter that the strait is closed. It doesn't matter that supply deficits are real. The chart says sell, so traders sell. And the selling feeds on itself until something changes the narrative. Now, let me show you what's happening with gold, because this is where the paradox becomes even clearer. Gold dropped from $5,600 to $4,700 during the same period, down $900, 17% decline. But gold's decline was much more orderly than silver's. Gold has support at $4,600. It's holding above its 50-day moving average. The chart damage is painful but not catastrophic. Silver's decline was a liquidation. Gold's decline was a correction. And that spread tells you everything about which metal the market trusts during actual crisis. When fear is theoretical, when tensions are building but no shots are fired, silver outperforms because it's higher beta, more volatile, bigger percentage moves. Traders love that leverage during the fear trade. But when fear becomes reality, when embassies get bombed and soldiers die, silver underperforms because it's too volatile, too risky, too exposed to margin liquidations and algorithmic selling. Gold holds up better because central banks buy gold, sovereign wealth funds buy gold, institutional allocations include gold. There's a permanent bid under gold from entities that don't care about volatility. Silver doesn't have that. Silver is a spec trade. And spec trades get destroyed when volatility explodes and margin requirements increase. Speaking of margin, let me show you what CME Group just did. They raised COMEX silver futures margins from 11% to 15% effective Monday after market close. That's a 36% increase in capital requirements to hold a silver contract. If you were holding 10 contracts on Friday, you need 36% more cash in your account by Monday to maintain those positions. If you don't have it, your broker liquidates you. And guess what happens when forced liquidation hits a market that's already dropping? It accelerates the decline, creates a feedback loop. Selling begets more selling. Margin calls trigger more margin calls. That's exactly what we saw Monday and Tuesday. CME raised margins. Silver was already weak. Specs who couldn't meet new requirements got liquidated. Their selling pushed prices lower. Lower prices triggered more stop losses. More stops created more selling. Classic margin call, death spiral. And it happened during an active war because the volatility from geopolitical chaos made CME raise margins in the first place. So Iran conflict didn't save silver. It killed silver. Because conflict created volatility. Volatility created margin hikes. Margin hikes created liquidations. Liquidations created the crash. Now let me show you what Bank of America is saying because their forecast just got a lot more complicated. Michael Widmer's $135 to $309 targets assumed gold-silver ratio compression to 25 or 14 to 1. But the ratio just widened. Gold at 4,700, silver at 80. That's a 58.7 to 1 ratio. The ratio was 53 to 1 at $90. It just widened 5 points in 2 days. Ratio widening means silver is underperforming gold, means the correlation is breaking down, means the leverage thesis is failing. And if the ratio keeps widening to 60 or 65, Bank of America's targets become mathematically impossible unless gold goes to 7,800 or 8,200, which is not going to happen. So either the ratio has to compress again or those targets are dead. And right now, the ratio is expanding, not compressing. Now, let me give you the bull case, because if I only showed you bearish data, I wouldn't deserve your time. The dollar at 99 is extended. It rallied 2.4% in 36 hours. That's parabolic. Parabolic moves don't last. If the dollar pulls back to 97 or 96, if profit-taking hits the greenback, silver could bounce hard, back to 85. Maybe 90 if momentum shifts. The Iran war is still escalating. Trump said it could last 4 to 5 weeks. If casualties mount, if the conflict spreads to Saudi oil fields, if supply disruptions get worse, fear could override dollar strength. Industrial supply deficits are still real. COMEX inventory is still below 100 million ounces. Shanghai premiums still exist, even if they compressed. The structural fundamentals didn't change, so this could be a brutal shakeout before the next leg higher. A margin flush that clears leverage and resets sentiment before silver makes another run at 100. But here's the problem with that thesis. It requires the dollar to weaken. And right now, every indicator says dollar strength continues. Oil at 97 means inflation risk. Inflation risk means Fed stays hawkish. Hawkish Fed means higher real yields. Higher real yields means stronger dollar. Stronger dollar means weaker silver. That feedback loop doesn't break until oil falls back to 80 or the Fed shifts dovish. And neither of those things is happening while the Strait of Hormuz is closed. So the bull case requires geopolitical de-escalation or dollar reversal or both. And I don't see either happening in the next week, which means silver could test 75, could break below 70 if selling accelerates, could revisit the January lows before finding a bottom. Now, let me show you the really disturbing part. The safe haven thesis just failed its biggest test in years. An actual war with Iran, embassy attacks, soldier deaths, oil supply disruptions, strait closure. That's the scenario where silver is supposed to shine, where fear drives demand, where investors pile into precious metals because nothing else is safe. Instead, silver crashed 16%, got sold harder than tech stocks, underperformed bonds, got destroyed by dollar strength and margin calls. If silver can't rally during this, what's the geopolitical scenario where it does rally? What has to happen for the safe haven thesis to work? The answer is dollar collapse. That's the only scenario where silver outperforms during crisis. If the dollar crashes, if confidence in U.S. currency breaks, if foreign central banks dump treasuries and flee to gold and silver, but that didn't happen. The opposite happened. Foreign capital fled to dollars, to treasuries, to the safest, most liquid assets on earth. And as long as that dynamic holds, as long as geopolitical chaos strengthens the dollar instead of weakening it, silver is not a safe haven. It's a risk asset that gets sold during uncertainty. That's the paradigm shift we're witnessing. Silver behaving like copper or oil or equities instead of behaving like gold, getting hit during sell-offs, rallying during risk on environments, moving with beta, not inverse to risk. If that's the new normal, if silver is now a pure momentum trade divorced from safe haven status, the entire thesis changes. You can't buy silver for protection anymore. You can only trade it for speculation. And speculation got crushed in the last 48 hours. Crushed by dollar strength, crushed by margin hikes, crushed by profit taking from retail holders who learned their lesson in January. Now here's my base case for the next 2 weeks. Silver tests 75 support. If it holds, we get a bounce back to 85 that fails. Then we chop between 75 and 85 until dollar strength exhausts or Iran situation resolves. If 75 breaks, next stop is 68 to 70. The pre-January crash consolidation zone. That would represent a full retracement of the Iran war rally and set up a major range between 70 and 90. For silver to reclaim 100, the dollar needs to break below 97. Fed needs to signal July cuts are back on the table. Oil needs to fall back to 80, and industrial buyers need to return. None of that happens while war is active. So ironically, peace is bullish for silver now. De-escalation is the scenario that weakens the dollar and brings buyers back. War is bearish because war strengthens the dollar and triggers margin liquidations. That's the paradox. The geopolitical crisis that was supposed to save silver is actually killing it. And every late buyer who bought at 90 or 95 thinking Iran meant automatic gains just learned the hardest lesson in commodity trading. Narratives don't matter when margin calls hit. Fundamentals don't matter when the dollar surges. Safe haven status doesn't matter when specs are over-leveraged. The only thing that matters is price. Price is telling traders silver is weak, at least for now, vulnerable to more downside until something fundamental changes. Dollar at 99, silver at 80, the war rages, embassies burn, soldiers die, and silver falls anyway. That's not how this was supposed to work, but that's exactly how it's working. And until the dollar reverses, until margin pressure eases, until specs clear out and industrial buyers return, silver is not going to 100. It's going to 75, maybe lower. The great profit-taking massacre just wiped out everyone who bought the geopolitical narrative at the top. And the paradox is complete. War didn't save silver, it destroyed it. Because this time the dollar is the safe haven, and silver is just another over-leveraged commodity getting liquidated in the chaos. March 4th, $1.99, silver 80, 6 American soldiers dead, the U.S. Embassy in Riyadh burning, and precious metals in freefall. Welcome to the new paradigm, where geopolitical chaos strengthens the dollar and kills the metals, where war is bearish for silver and peace might be the only thing that saves it. The math doesn't lie, the chart doesn't lie, and the dollar at 99 just proved that safe haven demand is dead until proven otherwise.